yes, you're great. Yes, you're great. No, not this sucks and it needs to get better.
This AI coming in and destroying legacy systems.
Why are we talking about my ex?
More competition makes the stars shine brighter.
There are people spinning up companies every single day. It's become the easiest it's ever been to start a company.
We have dads, we have moms, we have college kids, we have high school dropouts.
And if you're a winner, they're going to keep funding your ass until you get all the way there.
Is it easier or harder to raise money as a founder now than it was 5 years ago?
I'm going to say
thanks for tuning in and welcome to the Funding Table. This is a show where we discuss all things venture capital, startups, and raising money with the hopes that you avoid some of the costliest mistakes that we made. Now, before we get into it, if you're new here, welcome and thanks for tuning in. And if you're returning, it's been a little bit since our last episode and you might recognize some familiar faces, but there's some new ones here as well. So before we get into the main conversation, we'd love to just do some quick bios, introductions, so you know exactly who you're hearing from. I'll go first. My name is Max Goldberg. I'm a two-time exited startup founder, Techstars alum, and former investment banker. I'm currently the founder and managing partner of GoldCapital Consulting, where we help early-stage founders raise capital. Now, I'll turn it over to you, Mike. Welcome back.
Appreciate it. Good to see you, brother. Multi-time founder myself. Recently started this firm, First Time Founder Capital, where we work with early-stage founders to help them get to the point where they're both investable and investor ready.
Awesome. And we'll turn it over to the first new face, Sam Poon. Welcome to the Funding Table.
thank you so much. Like Max mentioned, my name is Sam Poon, and I was on the venture capital side for many years. And really, I was in the room where the decisions were made before founders actually got funded. And I've actually been on the other side as well, speaking with family offices and endowments, raising for those venture capital funds as well.
Awesome, Sam, and welcome. And the final new face, last but not least, Cameron Owen. Welcome.
Yeah, appreciate you guys having me here. Yeah, very nice to meet you. I haven't heard my full name used for quite some time, so thanks, Max. Yeah, I'm Cam. I'm the new face here. Former exited founder on all of that. I have also just bootstrapped up until this point, so no raising experience, similar to probably many of you that are watching. Been a blast learning more about it throughout the years, and have actually spoke with a lot of early stage startup founders, and similar to Max, help you all with the raising side of things now.
Awesome. Well, I think it's worth establishing sort of the lanes here. Again, if you're new, where two of us, Mike and myself, former exited founders who both raised money before. On Cameron's side, bootstrap founder who's talking to founders all day. And then, of course, Sam, the VC, the man from the dark side in the room. So I think we have some unique perspectives here and we have an interesting topic set for today. So without that, let's get into it. I think first and foremost, why are we doing this show? Why do we do the podcast? And I think that we want to make sure that startup founders who are thinking about raising money or actively raising, of course, can avoid some of the mistakes that we made on our own journeys or in the industry. But more so, these are the exact sort of conversations that we're having every day with paying clients of ours. Mike's firm FTFC and mine Gold Capital, of course, working with startups on their rounds. A lot of this is really gate-kept information. So our hope is that we can now open up the conversation, share a little bit more online with you for free of sort of the information that we keep with our paid engagements, with the hopes that at one point you become a paying client as well. So without further ado, why don't we get into it? Michael, we got a juicy headline in the news. We have a major event. There's a company bending spoons. There's Airtable. What the hell is going on and why is that relevant?
Yeah, man, this acquisition happened, 2 weeks ago or so? So all this information is just starting to flow through. Absolutely fascinating. I mean, they started in 2012, really became operational in 2013. They were raising their Series C to Series F in the peak ZERP era back during COVID. Their last valuation was $12 billion in 2021 for their Series F. And they just sold for 1.3 billion. I think
Yikes.
A little over 2 billion in equity total because they had 960 or so million in cash just sitting in their war chest. That's about an 80% haircut for anyone that's not trying to do public math here on that peak valuation. Tons of information's coming out. A lot of people are seeing this as the AI scaries, if you will. Is this AI coming in and destroying legacy systems? Did the founders walk away with zero? Did the investors walk away with zero? Is this a lose-lose for every side? Um, Crazy. Do you guys want to give some thoughts here before I dive into a little bit more of the specifics?
Well, yeah, I'd love to hear Sam. So you spent almost a decade in venture capital.
Yeah.
And from what Mike just said, it's still unclear exactly if the founders walked away with something. They might have taken secondaries on the way up, hopefully. But Sam, who came out here on top? Did anyone who lost money?
Yeah, that's a great question. And there's so much to unpack with AI, so I'm going to leave that till much later. So here's the thing. Who lost money and who made money and who made out like a bandit? So it's interesting that Mike mentioned the ZERP era, and let's just say that was until 2021. Well, actually, 2022 is when things got a little frothy, right? And really the thing is, even the late stage investors got their money back, what we call the liquidation preference. So they got a 1x on that. So they didn't lose money, but here's the thing, there's an opportunity cost and a time for that. They could have invested in other startups, but who's fine? Early funds did great. I think Airtable actually, their first round was in like 2015 or something, right? So they got in at a really good valuation. They got in cheap. And the founders, of course, they did fine. But who actually lost? Well, I'm just going to say it. The LPs could have invested in an index fund. The later stage investors actually only got their money back, and those returns look abysmal when you actually compare it
Yeah.
against, well, what the publics are doing. And honestly, the employees, they don't get those preference stocks. They get common stocks. So they're really last in line, and their options were really priced against that 11 billion. So they didn't do too
Ugh.
well. Didn't do it too well. Yeah.
Could and I'll chime in here. Just my thought on that is like, why then would someone even want to raise, like, as an early stage founder, we're talking to a lot of the pre-seeds, the seeds at that stage, then why do you go the VC route? If down the road, no matter, you could get this to $12 billion. Think about how much time and effort and sweat and tears that is just to get it there, only to then do basically like a $2 billion less than that exit. Why would you even raise VC then at that point?
I mean, that's a really good question. And at the end of the day, they would not have gotten to where they are today without VC dollars, right? They could have grown by profit, but I mean, they would be significantly further back than if they hadn't gotten those earlier rounds. And back to Sam's point, I was doing a little bit of digging, wanted to get all the skinny on this before this pod. But I saw that Freestyle, Box, Caffeinated Capital, even our guy Ashton Kutcher came in and got about a 45x return. They were the earliest, the seed investors. So at the end of the day, I mean, we're working with early stage founders, and a lot of our investors that we work with are early stage. And even in these scenarios with this 80% haircut, the valuations they were investing in were significantly lower than this, roughly 2 billion final sale price. So they're still making out. Very unfortunate for the later stage. Like Sam said, I mean, you're getting your money back. You invest, 300 million. You're going to get 300 million back, but that could have been tossed into a lot of different avenues and made a significant additional return there. I mean, we saw SpaceX IPO in the trillions. So this is definitely unused capital for the later stage investors.
For sure. I think there's a couple lessons here. So, assuming you're a founder tuning in here and you're looking to raise that first round of institutional capital, whether that's a pre-seed or a seed round, and you're thinking, well, I might be able to go a decade or more on a journey, break my back to make almost nothing, making even 5, 10, 20, 30 million dollars, which is the case in sort of these horrific outcomes on $1 billion outcome is really bad. You might be able to do better at creating like a local plumbing business or HVAC business or something like that if those are the sort of dollars that you make over a 13-year period of time. So I think if you're a founder raising a pre-seed or seed round, two things are extremely important. One is you have to understand the concept of a liquidation preference. And that really is the root cause here. And Sam mentioned it, although that might be Chinese to most people, because it was certainly Chinese to me when I first learned it. A liquidation preference, very simply, is that there are folks that might be more senior to you in an acquisition, meaning they're going to get paid out first. Your investors are always going to get paid out first because they have preferred stock usually a 1x liquidation preference. But if companies are in dire times or can't raise money, you might hear things called 2x or 3x liquidation preferences. Absolutely terrible, where some investors that come in at the tail end, you spent your whole life building the thing, might be entitled to double or triple their money out before you see anything and you found the company. So you got to be
Mm.
careful with liquidation preferences. And I think the second thing is we see a lot of performative founders in the Bay Area coming out of accelerators. I was in one that sort of view valuation as a prize, like, hoorah, I got my 20 to $30 million valuation at the idea stage. And that is more of an obligation, sort of as Indiana Hoosier alum, I am one, and Mark Cuban says, like, that's a promise. You have an obligation out to your investors. So don't celebrate the valuation because that's really just the start itself. I think just moving on here, Sam, the headlines are showing that VC funding is breaking just about every record. I don't have the exact stat on hand, but I think it's about already in the first half of 2026, there's been more capital raised than in all of 2025. And 41%, I'd like to say, of all venture dollars this year have gone into literally 2 or 3 companies, 2 of them being OpenAI and Anthropic. So I'm curious, right? VCs breaking every single record, but a lot of the founders that come in to either work with us or our clients are talking about how difficult it is to raise money, maybe the hardest it's ever been. Why is that? Let's dive a little bit deeper here.
Yeah, and Max, both things are true at the same time, where it's like record funding, but also it's really a tough time to fundraise. There's more money in venture capital than there's ever been. But here's the thing, it's already spoken for, and I'll get back to that point. Exactly like you mentioned, 2 companies, right? OpenAI, Anthropic, who doesn't know who they are? They took 40 to 45, almost 50% of every venture dollar on Earth, not just the United States, because we think, the US is the capital of venture capital. They're growing areas as well. But that only came out of 3 funding rounds, just 3. And here's what the actual record headlines hides. The thing is, fewer companies got funded than last year, not more. And even at the earliest stages, well, dollars went up about a third and the number of deals went down. So it might be record funding, but it's the same year, opposite directions, right? So if you're a founder and you're reading, okay, record funding, and you're thinking, all right, it'll be an easier time. What you're reading is that dollar amount and not the deal number.
Could I
But if
ask you
these,
something, Sam, on that? And I'll
Yeah.
chime in here with this just as a thought on a lot of the founders that I speak with every day. One of the issues seems to be then like it sounds like a lot of the smaller raises can actually get hindered because of that, even though they may only need 300K or 250,000. Well, those are the people that aren't getting funded. Do you think that maybe then going for a slightly larger amount because these VCs, these family offices at this point have their check sizes just gone up, as you mentioned, there's less deals, but more money in each deal. Does that mean that I, as a founder, should be looking for maybe more capital than what I actually thought, or did that hurt me?
It absolutely hurts you. I think having really VCs stress test for a few things. When you're pitching them, how much are you raising? Where is this going forwards? And honestly, what are you going to unlock with this? So raising just for the sake of raising, actually, and Max alluded to this, sets your expectation way higher. And if you don't meet
Mhm.
those metrics, well, in the future, your company might actually go under because you didn't meet those milestones. And a VC is thinking, you might actually never meet those metrics. And it sets the bar a little bit too high. So it's really strategic. And a lot of founders don't understand this. And it's super critical to be intentional and to really have a good plan in place.
but the
It's
converse
tough.
is also true, right? Because
Yeah.
sure, taking on more capital at higher valuations means a greater expectation and sort
Yeah.
of expectation of your company that you'll need to live up to, maybe on a sub
Yeah.
1 year timeline nowadays. Companies are raising so quickly, deploying capital, raising another round. In some cases, we've seen weeks. There's been hundreds of millions of dollars raised and hundreds of millions of dollars, raised again. I guess
Yeah.
my question is the opposite might be true, where, raising less money can be seen as sort of an anti-signal that maybe the founder isn't ambitious. Maybe they don't understand how venture capital works and sort of the market share grab that's expected and the grow or die nature of it. So I guess,
Yeah.
Mike, we have funds that are undeniably sitting on more capital than ever before. And they're clearly passing on some really good companies from a fundamentals perspective. I'm curious, how does this sort of outlook, macro environment change how much runway you should be raising for? Or is that not the way to think about it?
I think it's incredibly important to think about that. Just going back to one of Sam's points earlier, I mean, there's more venture dollars out there than ever before, but because of AI, there are more companies going out for that venture dollar than ever before as well, because people can launch over a weekend and start seeing ARR in record times, right? So you're going against a lot of companies, whether they're fantastic or they're bad, they're going to last a while or not. We've seen some companies that fizzle out in a year and a half after getting a big round.
Yep.
Right? It happens, but they're fighting over the same venture dollars that you are. So I think at the end of the day, I mean, there's always this sort of quandary, this question of, should I raise as much as possible so that I don't really have to worry about it when things start to break, or if the industry is going to be dry in a year from now. That's always a concern, but you also don't want to over leverage yourself. You also don't want to hit a valuation of 40 million pre-product or pre-revenue and then try and spend a year possibly getting to that point. Because yes, you may have a pre-seed investor who wants to jump in at that valuation. They see the future, et cetera, et cetera. You still have to go up against some of the people that have spent 15, 20, 50 years pricing rounds.
Yep.
And that's when things start to get real dicey, because they know exactly how to price those rounds. So going back to your initial question, Max, how much should they focus on runway? How much runway should they sort of bake in? I would say VCs are sort of expecting, another round in a year or so. If you're really scaling fast, 6 to 8 months, could be even shorter. Highly unlikely, but I've seen it. But I think it's the smartest move to bake in a bull case, right? 18 months, 24 months even. But ensure that if you do end up using that cash in 24 months and you go out for another round, you still need to have the metrics, the traction to raise that next round. So don't slow roll it. Don't sit on your money just so that you can sort of hold off for a rainy day. Obviously, have a little bit of working capital in the back end in the bank, but if you're raising 3 million, don't sit on 2 million for a year and a half.
Right.
As Max loves to say, it's called burn for a reason, baby.
So I was just about to say it, and I'm happy
There
you
we go.
gave a specific timeline there, because I think there's a lot of other folks in the industry content where they always give wishy-washy answers. But as you'll tell from this episode, and hopefully you tune into the others and become a client, we are straight talkers. We have opinions, and that doesn't mean that they're necessarily correct for every company. But I think what you're saying and sort of the takeaway is, well, I have an expectation of sort of what I might need to communicate to the venture market to raise additional capital and to sort of nurture the existing folks that are on my cap table. But maybe our internal strategy as founders or as a solo founder might be a little bit different, right? Where you sort of want to approach this in a contrarian way. If everyone's sort of burning cash right away, maybe it makes sense to prepare for a down cycle or take that more seriously to have that cushion. But that doesn't mean that needs to be core in your narrative. Right, you don't need to communicate that you're holding on like you're a hoarder, and you see that show and people hoard a lot of different things. The last thing you want to be hoarding are dollars, I think, but also just being smart because there's so many companies that are now dying, and we just talked about a terrible outcome for a company that probably wish they had more cash on hand, so they weren't bought for essentially their cash and their equity value. But Cam, I think just one thing I wanted to ask you, for those that don't know what you do, you're really on the front lines talking to folks that want to work with us. We have a very low acceptance rate. We have a tremendous amount of applicants on a monthly basis that try to work with our companies here. But you meet a lot of them. And you've been telling me lately how many folks come in and they just don't know how much they should be raising. They probably undershoot. They come in, internationally a lot of the times. I want to raise 500K. I want to raise 750K. That might be Canadian. That's even worse. And it sounds like lately you tend to walk them up maybe to the anywhere from $2 to $3 or so million range. And in most cases, I'm curious sort of what the response has been from folks when you tell them, hey, you might want to consider raising more money. Is that something that people even know is possible? Do they realize that might be strategic for them, or are they sort of at a loss and they think it's impossible?
No, no, I think that that's a great question, and I have been noticing that. I will put this out there for all of you UK founders. 500K is not the answer. For some reason on earth, every UK-based founder believes I ask them how much are you raising? 500K, without a doubt, every single time. I don't know if it just sounds good enough, and it's not to a million at
Dragon's
that point.
Den, Cam.
Yeah,
Dragon's
yeah,
Den.
it is 500K. So, look, whenever we get into that discussion there, I think I honestly see the gears start turning a bit. They're like, wait a minute, maybe everything that I have around me and going up to people and them saying, oh, you're too early, or you should be raising a little bit less than that. Sure, that's feasible. That's all you would need to get to the next rung. But VCs are fundamentally playing the game of I need you to get 5 rungs up the ladder as fast
Yeah.
as possible because most people fail at that point. And I need to know if you're a failure or a winner. And if you're a winner, they're going to keep funding your ass until you get all the way there. So with that point being said, like I think that they naturally start to grasp it, and it's fun to see that. But yeah, usually in these pre-seed seed rounds, it's not crazy to ask for $2 million, guys. It's really not.
Well, let
Yeah.
me drop a little knowledge here. So
Please do.
this is a question I get asked constantly. How much should we raise, et cetera, et cetera? We need this to hit these milestones. I think a core issue that a lot of especially first time founders don't think about is you don't necessarily you want to price out this round, but you also really need to look at what the next round traction metrics are for the current market, right? So what are investors investing in at seed stage or Series A? Are you actually going to hit those traction metrics with that amount? If you raise 500K, are you actually going to be able to raise that next round, be front in line? That's what I always tell founders is you want to ensure that you're raising enough so that you can be front in line for that
I
next
don't know
round.
if these people have ever ran like advertisements and have any fucking clue how much you have to put in towards the marketing spend on things. Like
Correct.
500K gets you to like next month. So
Yep.
to Mike's point, I think what you're hitting on there is like to get to those metrics you're going to need to raise in the future, you need more than probably what you're thinking of right now because it's going to take a lot to get you to those metrics.
Yeah, of course. And you don't want to be that founder that gets 10 yards away from being first in line or even being potentially accepted by VCs, but you've burned through all your cash. So now do you raise a bridge round or do you just try
Right.
and grow by profit to get enough traction or really, get even stronger as a business? I mean, it's a really tricky spot to be in. And I've seen it happen, many, many times where they just haven't raised enough.
But that's the key, though, right? That's the key is that a lot of folks come in who have not done this before, and sort of their definitions of success or what they would need to get done with the round, if they're even thinking about it along those lines. Sometimes they don't even realize that, yeah, they're going to be like 2 or 3 KPIs that are probably important to hit, and investors are going to hold you to that. And frankly, you should hold yourselves to it. But even if they are coming in with that sort of like sophisticated, they're in tune with how VCs think about it, they tend to view their growth in a subjective manner. They're like in their own lane. But as we talked about, if one of $2, or sorry, 50 cents on every dollar, I guess same thing, right? Are going toward 2 companies that have grown from like zero to billions of dollars in ARR in 18 months, 36 months. I mean, it's even faster than that. This is an objective sort of landscape of where you need to land. You can't determine what success looks like in a vacuum. You have to factor in what the other companies are coming in because VC is a zero sum game. I think a lot of folks forget that. You're not just competing against your direct competitors in a race. You actually are competing against Sam Altman and Dario and some of these crazy people. I mean, these are real cannibals, right? You're competing against them. They're very good at raising money. They sold everyone that they're all going to be replaced and that we're going to have no jobs. That's clearly not occurring, or at least not yet. But it was a really good fundraising strategy. Now, one thing that I want to go over is, there's a formulaic way to think about how much you need to raise. And I don't like to distill things down to formulas. We don't really standardize things because of all our engagements are custom and we're personalized based on that founder and startup situation. But really the formula is cash needed to get to the next milestones or the cost of getting to the next milestones plus a buffer, right? That's that margin of error sized to what VCs expect for companies in your space. So it's almost that you can create that buffer, you can figure out like the sort of the absolute cost, but then it's on a curve. and you sort of have to see where other folks are raising. Um, Look, just I guess really
Can I
get to yeah. Go ahead, Mike.
I want to ask Sam a question because I've
Yeah.
seen this a handful of times recently, and I think it's amusing. Sam, let's say a company comes to you back in your VC days. They're raising $2 million, and you look through their financials and see that as soon as the raise is done, the CEO is going to pay themselves 500K. What do you say?
Does that happen?
Or
Oh
even
man.
300K or 250K the first year?
Yeah, there is really an expectation and really a range within pre-seed, seed, Series A, and beyond that, what a founder, a co-founder, what an engineer should be paid. And the whole thing about venture capital, when we hear a pitch, if we see any misalignment, we start to think, all right, maybe the incentives aren't there. Maybe they think it's all glamour and it's a cushy job. Are you ready to grind through that pain? Are you actually in this? Well, if you didn't raise a single dollar of venture capital, would you still be building this company? And sometimes it's like, all right, I want to do all these things. I want my lifestyle to change. Well, that'll happen eventually if you're successful and you're in it for the right reasons. So when I hear those things, I mean, everyone shouldn't be eating ramen noodles every day. I mean, nothing wrong against ramen noodles, but it's
I
you
like
might
ramen.
want to. I do too.
Ramen's
I
all
do
right.
too. Ramen's great.
But Sam, I was a management
Yeah,
consultant at McKinsey for 2 years.
yeah,
How do you
yeah.
expect me to live off of less than $250,000 a year? I live in the Bay Area.
Well, that's funny you mentioned the Bay Area because we're in Boston and it's not too cheap here as well, actually. It's really setting what you want to do. And it's management consulting. All right, it pays well. The hours might be long, but in startup world, the hours might be even longer. You're wearing many different hats. You're doing all these different things. You're talking to customers. You're talking to venture capitalists. You're actually speaking with suppliers and really working on your supply chain. So it's very different, and you have to be in it for the right reasons, right? And one of the things that we check as venture capitalists, it's your market, what you're building, what's going on in the macro environment, but also it's a gut check on the founder. Is your passion there? Do you
Yeah.
really have domain expertise? And well, like I said, are you in it for the right reasons?
I think that's well said. Look, I want to transition here, but before we do it, maybe Sam, I can ask you,
Sure.
um, honest answer.
Yeah.
Is it easier or harder to raise money as a founder now than it was 5 years ago?
I'm going to say it is way harder now to raise money than it was 5 years ago. And I'm going to stick with that.
Mike?
I'm in the same boat. Like I said earlier, more venture dollars than ever, but more companies coming out fighting for those dollars.
Tell me about that competition, that fight. What does that mean?
I mean, look, you look at some of these industries where, um, you have, let's say, like scribes, AI scribes for healthcare,
Yeah.
right? About
Yes.
a year and a half ago, 2 years ago, this was sort of a brand new idea. And then about 30 days after that,
Yeah.
there were
Commodity.
60 people in the market trying to compete for those venture dollars. So it is specific towards your industry. Certainly, is this something extremely novel? Is this something that is not being tried or only has one or two competitors? But there are people spinning up companies every single day. It's become the
Right.
easiest it's ever been to start a company, become an entrepreneur. And I think at this day and age, with all of the content out there, everyone thinks that they should be on that venture route.
Yeah.
So you're competing against every single person that's trying to build a company and go on that flywheel.
Cam, what about you? You talk to founders
I
all day.
Yeah, I'm going to take the direct opposite approach because, to your point, Mike, there is more people than ever raising capital. There is more people building that. Guess what? Those people oftentimes they should not be building their businesses. And so, when you are a true startup founder that has an understanding of where you're going, that has domain expertise, and let's just be real here. Yes, you can build anything nowadays quite quickly. So you can reach that scale that you need to raise some serious dollars. This is a game of distribution. And if you can nail distribution, it has never been easier to stand out and to raise a real sum of money in venture capital or with family offices or the like. I'm going to go the direct opposite. I think that more competition makes the stars shine brighter.
Yeah, I'll give my take. I think it's way easier to raise venture capital now than it was 5 years ago. Although it is way more competitive if you're genuinely a killer and understand that you have maximum leverage and there are zero barriers to entry anymore. Uh, then through that lens, it's you're going to be able to seize the opportunity. I mean, when I was starting to raise money for the first time, even putting together a small friends and family round in 2021 when I was a sophomore in college, and I went online to look up sort of content. How do I raise money? How do I talk to investors? Literally all that exists was YC Startup School, which is phenomenal and still is. And that was really early. They had like a lot of, I think the 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 aristocrats of YC have changed. That was the Michael Seibel days. There were a lot of folks that are putting out content there that Dalton that are no longer there. Um, and on Instagram and TikTok, even TikTok was barely a thing in 2021. Certainly YouTube, there was almost no content. It's like Alex Ramosi, YC Startup School, and there's nothing that was in between. So I think that's sort of a gap, obviously, we're selfishly trying to fill, but there's so much more leverage. So there's about 1,000 more startup accelerators that can get you started. Pretty much every major American college and even some European colleges have programs devoted to giving you your first check. And now distribution is free, product development is free. Our grandparents building businesses in a time where it was like manufacturing and like textiles, even maybe that's a little older. You had to have incredible access to capital to even get started. So you can prove something out very easily now, but you really have to go the extra mile to stand out. Having $50,000 of your uncle's money to go build an app is actually not an advantage anymore like it used to be. Now it's truly about, it's a skill issue. I really think it's a skill issue.
Right.
And that's that. So I guess moving on here, Ham, you recently were telling me a story that I thought I'd bring up. You're speaking to
Yep.
someone that came in, applied to work with Gold Capital and FTFC. They ended up becoming a client. We'll keep sort of like all the details anonymous to respect this confidentiality, but this gentleman's named James, right? Experienced founder. He'd been an operator, worked in corporate turnarounds, and he's sort of wondering, how much should I be leading into AI as a founder? And I know you told me that they weren't necessarily an AI native business, but they felt silly not mentioning it. How do you
Yeah.
navigate that as a founder? Do you have to lean into it? Do you not?
Yeah, I think that it's a great question, and obviously the story is, yeah, we'll keep everything confidential. However, the biggest issue that they were running into is that finding investors that are not just AI crazy. I mean, I think that we were discussing this the other day, and if I'm not mistaken, we're seeing now like 80x forward-looking multiples or something, I believe. It's like, how can you not want to claim AI in what you're building? But I
Yeah.
think that there's a fine line of deciding how you use it, how you scale with it, what piece of you is. But that's, I guess, my big question, and for all of you as well, too, is like a lot of founders are seeing this. They're like, look, I'm not really an AI company, but do I kind of BS my way and tell an investor that I am very much leveraging AI? And then I just kind of sound like everybody else. And I guess I would love to hear Sam's point more than anything as a VC. What do you think of people that then try to claim that they're an AI company and probably at the core of it really might not be? Is that advantageous, or is that like, hey, we've now seen so many of these fail that we don't want that. We'd rather just see the raw than take a look. You tell me.
Yeah, absolutely. And we've seen the shift in the market, and that's a lot of what founders don't really realize. They might come from the corporate world where, listen, it's financial statements are public, and this is how you should run the company, and this is the expectation. But in the startup world, expectations really shift. 5 years ago, it was all about growth, and then it became about profitability. Nowadays, in the era of AI, I would say it's a mixture of growth, but also defensibility. So here's the thing. If you're claiming that you're an AI company, the first thing an investor is going to look at are your margins, right? If you call yourself AI and your gross margins look really like a services business, well,
Yeah.
a VC is going to think you must be paying humans somewhere within that loop. And you just didn't mention it. We're going to sniff that. We're going to stress test that. And here's the thing, too, it's retention. AI really gets people to really try your product, but the real product is what keeps them. So one question I would actually ask them is, what would happen if Anthropic, OpenAI, or Frontier Lab actually ships this exact feature you're trying to build next month? And if your answer is, we might lose in this space. Well, that's not a company. It's a head start and it's a feature. So that's something to keep in mind.
So I guess
It's
Sam,
worth noting.
my question that I sort of want to call out here is
Yep.
Silicon Valley and internet companies, right? You mentioned like the sniff test has
Yep.
sort of been dominated by for all time, and it's gotten plenty of folks in trouble, including recently a very, very wealthy gentleman's daughter. But sort of different, this sort of fake it till you make it mentality, where you're building a marketplace business. It's
Yep.
it's unimaginable to build a LinkedIn or Airbnb. Obviously, hindsight's 2020, where you don't have some sort of like either viral or almost like artificially forged mechanism to get other folks on the platform, right? Gaming companies have done this for years, right? They have multiplayer mode, but you're playing against an AI in the early days because they don't have enough people to match you up. And a lot of users don't know that, but that's sort of like an unspoken and now even spoken truth that this is how companies tend to get started, right? It's just branded as do things that don't scale, which can certainly help a company, but you can also cross that line. I'm curious. So we heard a story from a client who
Yep.
mentioned that there was a startup and they were basically doing AI checkouts where like the service can help you check out on online. And it was this really cool functionality marketed as an AI native platform. And it turns out that they actually have 100 hopefully adults in a Filipino click farm that are actually doing the checkouts and there's zero AI, there's no agentic use case, nothing. And the founder gets charged with fraud. Again,
Yep.
feel free to fact check the story, but we can imagine that this is real because we've heard stuff like this. So I'm
Yep.
curious in due diligence, what would be, other than the margins that you mentioned, what would be a telltale sign that maybe something like that is going on? And then, sort of on Mike's end, when you're talking with clients, I'd be also curious to know after how much can you lean into these like fake it till you make it sort of opportunities that are so tempting with agents to get the multiple or not? Like, is that a viable strategy? Do we encourage folks to do that or not? The doozy, Sam. Let's
Yeah,
hear from you first.
it's an absolute doozy. And I'll say that founders typically pitch what they built, right? Because constantly they're selling, they're hiring, and they're shipping all day. So really that's the founder muscle, right? But that's really a customer pitch. What VCs do internally is the investment committee, and it runs a completely different exercise. These calls are 3 hours. We're looking at the data room. We're stress testing your customers, like your product. And I won't go into specifics, but even frictionless checkout was a thing for a while. You see it,
Mm-hmm.
startups tried it, big companies, incumbents that we all know about tried this. And they found out, well, this wasn't frictionless at all. We actually have people verifying your receipts at the end of the day. And we're constantly on customer calls and we look at the market and where things can go wrong and actually where it actually will go wrong. But we also look at the business model and whether it expands, the competitive landscape, and Cam mentioned this, your distribution. So we look at what can go right and what could go wrong. And it's super intentional. And during the boom cycles, most companies will go a little light on their diligence on startups, but that's not the way I was taught. And I think it's important for a founder to really be aware of that. Hey, it's you might have the best product, you might be the right people to do it, but does your story hold up? So it's really important to remember, well, one thing I would say is you have to answer these questions internally before you even speak with an investor. You can't just go in there and hope for the
Right.
best, right? Can't do that.
I have a strong answer, a strong preference for this. Um, Look, I said hi to Claude this morning, right? That doesn't mean that FTFC is an AI native company,
Right.
Yep.
right? I think if you're not AI native, if you're not actually an AI company, just because there's a big AI boom and a lot of investors are looking for those types of companies, I think you should own it and just flip the conversation to be, while we're not currently AI native, that doesn't mean we won't be. That doesn't mean we can't build in those capabilities. Here's how we're utilizing AI internally today on our team side, on our operations side.
Right.
This company isn't necessarily an AI company. We're not building the next chatbot, but we're leveraging AI in a way that makes us 10x more effective, right? If you come in and you lie about it, you try and fake it till you make it, and an investor opens up the data room and they don't see any sort of AI infrastructure in your product folder, that's going to be their first question is, where is that? Are you going to build that? Is it going to be, are you going to continue this sort of facade? Or are you going to tell them the honest truth? So why not just go with the honest truth to begin with and focus on finding investors that are open to investing in these types of companies?
I
Right.
think
Because
that you just take, yeah. Go ahead,
every
Mike.
investor is investing in AI, but you also have investors that are still investing in companies that are leveraging AI. They're just
Right.
not AI native.
I
Right.
think that you take that stark stance. I think Elon saying he's going to build rockets, that doesn't mean much, but Elon saying he's going to colonize Mars does. Like, take the stark stance. Say, here, yes, we're not a completely AI-based company. Here's why, though. Here's why we haven't done that. And if you don't have a good why, then become the AI company. If there's a reason
Yeah.
why you should be using AI, use it then, implement it, and then go raise for it. I think that that stark stance can actually work in your favor, but I would also, same with the other two, definitely not recommend to just claim and put up this facade that you are an AI company just to try to raise capital. Never the
Yeah.
case.
Yeah.
And I think what was mentioned, Mike mentioned one word specifically, this concept of a data room, and that might
Yeah.
be unfamiliar to some. And interestingly, when I posted a piece of content months ago, I think at this point on my Instagram that, founders, you need to have your data room ready. I'm getting a whole host of comments from a lot of know-it-alls. They've never raised money before. They probably don't have any money, but they say, you don't need a data room. What does this guy know? Sam at this point's probably reviewed thousands of data rooms as a VC. Mike has worked with, probably at least over 100 to 300 data rooms over the last, 3 or so years, whether they're clients or not that you reviewed. A data room is an essential deliverable as part of your fundraise. All that is some boring bureaucratic process of assembling all the legal documents, tax IDs, and corporation documents, repositories. It might seem simple, but when you need these detailed write-ups, when you understand that there's strategy, not just in how VCs actually consume the diligence materials or the lack of that consumption, which is probably not such a good thing, but now with AI, I just got off the phone and no one expected this. This is the first time I'm dropping free game on this podcast for you if you're listening. My buddy, who I went through Techstars with, he had a separate company. After his company got wound down, he got into Y Combinator and is now building a massive AI defense tech company. They just crossed, well, he'd be mad if I gave his metrics out, but let's just say close to $10 million in ARR as of last quarter. They're growing very quickly. They've raised from Paul Graham, from Pear, from CRV, and a number of other pretty amazing investors. And they just went out to raise their Series A, I believe, 1 week ago. And he was laughing. He said, Max, we sent their data room and we sent the financial model. And he's like, oh, by the way, we didn't do a financial model for our seed raise. No one even asked for it, which I thought was interesting. But he basically sends the data room and all of the VCs and for the Series A, the leads just start passing all the major funds. And they're saying that the data room, the financial health of the company is not strong enough. And when they took the model and ran it through their own sort of Claude window, they were getting the same response. This company sucks. So what they found is, first thing is that VCs are incredibly lazy in some cases, and they are just taking your data room and dropping it into their Claude window, and then they're going to pass or not based on what Claude says. Scary. We have clients who do that with our agreements as well. So that's a story for another day. You probably want to use your brain. Don't work with us if you don't know how to use your brain, because you're never going to make it in this industry. That's for sure, or at all. But if you do, what they did is they added small footnotes to the bottom of the Excel workbook, contextualizing numbers, explaining that, yes, some part was contracted revenue and some part was more design revenue. And all of a sudden, would you look at that, that Claude instance is now telling you to invest immediately. And now their conversations are progressing. So a small change guiding the AI that you know is going to be used in reviewing probably all your materials, that is free game for anyone that's listening. And again, if you get any value from these conversations, like, you can probably just imagine what you actually get as a client, because we basically won't go into 95% of what we know or can do with you. But anywho, Cam, just to wrap this up very quickly. So you have someone like James, you have a startup founder coming in. How much do I lean into AI? GoldCapital and FTFC, if we become a client of these sort of shared clients of these companies, what are you telling folks that come in? Just generally, what are you telling them?
The general take is a lot of what we've discussed here. I say like don't over leverage yourself. I actually think that's going to hurt you. I think that in just the last year alone, enough investors have fallen for it and then now are kind of putting up their guards. They're saying, okay, we are going to do exactly what Sam said. We're going to do the sniff test. So again, going into it and saying we are an AI native company all throughout, even when you're definitely not, don't do that. It's going to hurt you more than anything. You're going to get to diligence. You're going to maybe even get slightly after that conversation. You're going to get blocked and it's not going to work. So just be truthful. And again, if there is a reason why you should have AI, implement it. If there's not, own it and tell people why you're not using it because it doesn't make sense. It doesn't make sense for everybody. So that's really
Yeah.
what I'm going with in the conversations I'm having.
Hear you. And look, if you're confused or your current positioning is not working, this is a great purpose. And I guess time, another shameless plug is if you click the link in the description, you can apply on our website. And if all makes sense, we'll book a call with you completely free to go over your situation. But these are exactly sort of the problems we want to tackle. And even if we don't know, we can go to market test, get you in front of investors, and we're going to learn pretty quickly what sort of that positioning needs to be. I guess moving on here, sort of wrapping up, really hot topic that's going on, maybe the most viral conversation headline that's going on, certainly on X, Twitter. Um, do we call it X or Twitter? I guess I still call it both. Depends on the
I go
context.
with both.
I call it
I
both.
go with both.
Yeah,
Yeah.
on X, it's making its way into like every founder's group chat. If you're in this bubble, VCs is this Travis Kalanick announcement interview. Adams, Uber. Just if you don't know who this is, Travis Kalanick, TK, was the founder of Uber. Obviously, a legendary founder with a real temper. It sounds like, but no doubt a legend and one of the biggest companies ever created. And it turns out that he, over the past like multiple years, almost like, was it half a decade? It could have been 6 years, is in stealth. Employees are under ruthlessly strict NDAs, building physical AI, a company called Atoms. And he does this podcast interview. Sort of the hot take there is that he basically, I think he paraphrasing or maybe an exact quote is basically saying that maybe 1% of VCs are actually helpful and provide value, and the rest are either like a complete distraction or outright destroy value and are completely unhelpful. Sam, you were an employee at a fund as of a quarter ago. What do you actually think about this? Are VCs helpful? Are they not?
Yeah. I'll just say this. I'll start off by saying I call it Twitter because when we say X, it's like, why are we talking about my ex? But that's the thing about Travis Kalanick, right? Former general partner I worked with, really great guy, smart guy, down to earth, as most of the VCs in my network are just good people. He worked directly with Travis, and he was an early investor in Uber. And like you said, Travis has a lot of hot takes, but I will say this. The best VCs should go into a call with a founder and expect to learn something. What VCs have seen are the ebbs and flows of downturns, hot markets. That being said, most VCs trip themselves up by saying, I need to be on a call every week. I need to set this direction. Sometimes they get in the way of the founder when it should really be about writing the check, opening up those partnerships. And these could be quarterly calls like, listen, how's the company doing? Is there anything we can do? Because we've seen this, we know these people. Some VCs get in the weeds a little too much. That's what I'll say.
Well, I think there needs to be a fundamental match between the founder and the VC. From what I've seen about TK, I can't imagine that he is one for daily stand-ups with his investors. I can't imagine with his network, his knowledge, his capabilities that he's looking for the really like get down in the dirt type of hands-on value add investor. Whereas someone that's never done this before is really, benefiting from that in a significant way. Right. So I think at the end of the day, the founder needs to understand what type of investor they want. Do they need the hand holding? Do they want to just be left alone? Let me take the cash and tell you like how it's going in a year from now when I'm looking for more. Yeah, I mean, I think if you're not looking for value and you have investors breathing down your neck all the time, you're going to say that type of thing. But I've seen investors provide a significant amount of value and the founder is looking for it.
But
Yeah,
we've seen
100%.
investors destroy it. And I think that one thing I want to call out exactly here, because this is sensitive, is that the DOJ, so for international folks tuning in, that's the US Department of Justice, is actually probing A16Z and Andreessen Horowitz right now over board seats. So we had two companies that portcos of A16Z, Databricks and Fivetran, and they became competitors. And there's a sort of antiquated 1914 antitrust statute that is almost never applied to VCs and has never been, that is sort of now regulating how people that are on boards, what they can disclose to management companies in their portfolio companies, which is really interesting. So if you are pinning two of your portfolio companies against each other, right? That's what's alleged, at least, and that's what's being investigated. Uh, does this make some of the top firms board shy? Like, do you want potentially VCs on your board that have like incredibly large portfolios of companies that have a lot to lose because they're farther along? Like, what does that mean for like the VCs and the founders that let folks come onto their board when they raise, larger amounts of money? Sam, I'm curious your take there.
Wow, I didn't expect to hear that question just because everything ties together. And I can talk about venture capital all day. I could talk about the history of like Dodd-Frank Act and how that had exclusions for venture capital. You see,
Yep.
I see smiles already. It's like, all right, Sam's getting into it. I think for founders, they should be optimistic and excited. If you are not one of those companies that raise these mega rounds, that means there will be more opportunities from emerging managers. And because what's the statistic? I think it's like 90%, maybe like 73% or something of all dollars were raised from the mega funds, right?
Yep.
But those funds can really take the hits when they get it wrong. They're great investors, but they can take the hit more. The emerging managers have that chip on their shoulder, and they're the ones that invest in the companies that have these great ideas. So that being said, those investors that have been around for a while and have these mega rounds will take these board seats, and they're more inclined to. But I think as a founder, you should see this more as an opportunity. And I told you I'd get into this, but most of the most of the time, founders don't realize that venture funds have a clock and a rule as well. And 2022 was probably the last year when things got really hot, and then there was a downturn. But there's a timeline where they have to deploy this capital. We're almost in 2027 now, and it's usually a 5-year time cycle. So I think there's going to be way more opportunities right now for founders to get capital and for the emerging managers that see something that isn't following the trend.
Sure. And I guess on that note, that's a nice way to wrap up this
Yeah.
piece. But before we get to our close here in a few, so stick around for that. But um, let's say you're a non-frontier founder. You are not a former OpenAI employee. You are not a member of Anthropic's technical staff, which turns out to be probably the most Avenger-like roster of technical talent. It's former founders at pretty much every billion-dollar folks that are going to be individual contributors at Anthropic. They're obviously looking to cash in on that IPO that's coming up here. But um, you're a founder. You're Main Street. You're normal, sort of like how we all started. What is the okay? You're a normal founder. I'm getting excited here. You're gearing up for a seed round in 90 days. Oh, and they're going to get me because I did this. They're going to mention in the comments that I did that shape. I just noticed that. Oh, Illuminati, right? You're gearing up for a seed round in the next 90 days. From everything that was discussed, like sort of like tight answer, everything discussed on the show, what's one thing that you're going to do or one thing that you're going to do differently based on what we discussed to be successful? And I actually want to start with you, Mike.
Can I start with what I wouldn't do?
Yeah.
Ooh, and triggering.
Don't wait until you have 30 days of cash left. I have had this conversation too many times. It is very unlikely that you'll raise a round in 30 days unless you're incredibly hot. You don't want to put yourself in a position where if you can't do this very, very difficult thing, your company is under.
Mhm.
But it does happen.
What I would do,
It does happen, though.
It does. It does. Don't get me wrong. It can happen, but it's not what happens most frequently. So
Correct.
don't put yourself in that detrimental position. What I would do is two things. Everyone can build companies these days, as I've mentioned before. Not everyone can build traction in a quick and significant way. Every single investor is looking for that traction story and how you got it and how it's sustainable and how it's scalable. Traction, traction, traction. Incredibly difficult to raise pre-traction these days. So focus heavily on traction and find the right investors. Not every single company is going to be a good fit for A16Z or Sequoia or some of these brand names that a lot of founders want to bring onto their cap table because they're fantastic. They have a great history. But you also have some of these, Sam was talking about emerging managers, fund one, fund two, fund three, that can bring in that immense value and that are looking for exactly your type of company. So you don't necessarily need to just go after the big guys. Try and do a little bit of digging, which a lot of founders don't do. Try and do a little bit of digging on who would be the best fit and who has the right portfolio that you could partner with or leverage as customers, things along those lines. Try and really dig in and understand what that ideal investor profile is, build out that list and go for it.
Got it. So it sounds like primary advice is, first of all, do not come into a raise thinking that 30 days is going to be enough time to get that done to completion. Even though we've had clients that have raised in timelines that are extremely fast, it does happen with help, especially if you don't have help. That is not a realistic timeline. And frankly, it's not a realistic timeline if you're working with folks that are highly connected, right? Baking in a good 60 to 90 days of solid fundraising because there is prep work, because the materials and everything have to be ready, the intros aligned before you're even taking that first call. There is a lead time. It isn't something you engage a firm like ours and tomorrow you're talking to investors. That just doesn't work. And if someone out there is selling something like that, it's either cold outreach or they are completely, they're scumbags, fakers, and thieves. And I'm putting out some videos about the fakers and thieves because I'm getting sick and tired of them in our industry. It's unbelievable, as we all know. But it sounds like the good things to do is really focus on distribution and really get serious about who are the right investor archetypes, what are the fund names, and how the hell do I get network to them? Because that is part of the job. You need warm intros because that's part of the test. How are you going to ever recruit top talent? How are you ever going to convince VCs that you are able to sell enterprise logos or achieve millions of users or hire an incredible leader to run a part of your business as you scale? You can't even figure out a way to network your way to that investor. There are shortcuts, but the test still exists regardless. And if we can be a shortcut for you, you know where the link is in the description. But anyway, Sam, curious, things that based on this conversation, let's just keep this really tight. The number one, do this. This is going to increase your rounds odds of getting done, and a don't do as well.
Don't do, I would say, is fill the round just to complete the round, really echoing Mike's statement about finding the right investors. What you should do is come talk to me. That's why I do it, right? It's in venture capital, we're meeting companies or doing the research or making a decision. But I wanted to get closer to the work with founders because these are founders that I think are outstanding. They're building something that's amazing, but they don't have their narrative right and they're not aligned to how investors expect it. So come talk to me, but that's a cop-out answer. But really,
so your answer is talk to Sam.
Talk to me.
Talk to Sam.
Okay,
I could talk about this all day.
Concur.
I told you I could talk about this all day. So I'm just gonna say, come talk to me, and then we can talk about it. How about that?
What about a don't do?
Don't do. Don't raise money just for the sake of thinking I'm going to reach an arbitrary revenue milestone. Really think things through. Think about who you're targeting, how that's going to change in 6 months, 12 months, 18 months, and then in 3 to 5 years. So be super intentional and deliberate, I would say. So don't just do it because it seems glamorous, like I said. So be intentional. Be intentional.
Gotcha. So it sounds like don't build your product for VCs exclusively. Try to build a real enduring business and let that stand for itself.
Yeah.
Talk to you. That would be important. And again, I think we would all agree. Seeking out advice from people that have done this before, that can speak to the founding position, and also the insider who's been in the rooms, who's made the countless rejections of deals that you're throwing out, could be great companies. You probably had to make a lot of choices, and that experience is going to be great. But then also just having like a very honest accounting of where you need to be successful, so that you're coming across as ambitious relative to your peers or maybe even indirect competitors, but also being honest with what you can achieve, because getting one round done and then not being able to achieve the metrics that you promised, if you're able to do that, the company is going to be done very likely. Cam, you're constantly on the front lines. Again, you're talking with founders. They ask you things like this all the time, dropping value for free, like literally day in, day out. Your job is to just diagnose like a doctor and tell them what to do. What is the number one thing that founders should not do to get a seed round done in the next 90 days? And then how would you turn that around and help them get that done?
The number one thing, and this is true for literally anything you do in life, is just not prepare. So think that you have everything done. Think that you can just it's like a study for the test the night before. I'll just throw this together. I'm sure I'll find some people that can give me a couple $1 million for my business. Easy. Not preparing is the worst thing that you can do. And being I guess, introspective, not having that say like, hey, I probably, if I've never raised capital before, maybe I don't know what the hell I'm doing and I probably should get it figured out, and at least do some sort of research. Work with us. If you don't need to work with us, great. You can definitely do it yourself. That's all right too. Like, go on your own, but it's just going to take a lot more time. But put in that time and map that out so that you're not doing this the night before you're meeting with investors, or to Mike's point, the day before you run out of money. Plan for this. This is going to be a timely process. So not prepping would be my biggest thing. That's just for anything though. In
I
terms
guess
of what, go ahead.
Go ahead.
Yeah.
No, go ahead.
Yeah.
Go ahead.
If I'm gonna say what to do though, this is a little bit more free value, because I'd say I have this conversation with people every single day. Figure out your why you and your why now. That is sales. This is sales on steroids. You're talking about millions of dollars from an investor going to your business. You have to not just be able to describe your company, not be able to say, hey, I'm an AI scribe. Well, I know what an AI scribe does. Why are you the exceptional founder that is going to make the pivots and change this company into a large scale beast that needs to be for me to see an expected outcome? That's what you need to tell them. Why you? Why you're that person? And why is now the time uniquely suited to make that happen? Figure out those two things. That's sales in everything in every industry. Same thing here. This is sales on steroids. Figure out your why you and your why now. Now I'll
Totally
get off my
agree.
soapbox.
Yeah, that's great. Timing is everything. Knowing how to market yourself, again, that story is what is ultimately going to help you raise capital. That's what's going to help you get customers, right? Um, but I think you're totally right that, when you're thinking about raising money, this is not a half-assed approach. You can't win and be successful with a half-assed approach. You have to either be all in, or you're fully out. A very much a
It's a
one-way
full-time
door.
job.
Yeah. And just from like the conversations you have with founders, our clients, it's so interesting that, we hear all the time. I mean, we have email screenshots. I mean, it's all of our website, stuff like that. But we have just constant praise. Forget about outcomes even for a second, whether it's to Sam, whether it's to Mike, whether it's to Kim, whether it's to the team as a whole, that they fundamentally changed how they view their business. They think about being an entrepreneur. We have dads, we have moms, we have college kids, we have high school dropouts. We've worked with a pretty wide ranging amount of clients from the US, Canada, Australia, New Zealand. We've seen it all. And there are massive cultural differences. But what we find is that no matter what, after the process, they all have urgency. They're all moving with maximum speed. They all understand the need to be default alive and not stagnate. And I think that when they come into working with us, some folks sort of think that this might be more of a passive approach, and they're not willing to make the investment to work with us because it ain't going to be cheap. They're not willing to recognize that they need help, more so to move quickly, right? It's not just the unknowns or the relationships. It's like, do you have anyone in your life that is actually a fire under your ass? And for the vast majority of people, it's sad. It's no. They have zero accountability. Yes, you're great. Yes, you're great. No, not this sucks and it needs to get better. So if you want that sort of help, you're always going to have to seek it out. And I guess like segueing into my answer, I think the number one thing you need to do is you need one of two things. You either need pedigree or some sort of seal of approval from the industry, or you need to be prepared to invest and work 1,000 times harder than someone else. It is unfortunately the case of the world that, yes, if you are a ex-Stanford undergrad, computer science, or whatever it is, or a Harvard dropout, you're always going to have an easier time at raising capital. It's not just because you might be a very intelligent person, not everyone is, but because you have like societal seals of approval. And there also are a lot of alumni from those like epicenters that run the industry and capital markets. It's not just that you're smarter. There are schools like Harvard and Stanford and Wharton that run capital markets and have continued that legacy, that it's easier to raise than a founder in Yale. Like, you're much more likely to be a Supreme Court justice than raise a Series B if you went to Yale. I honestly, fact check me on that. I think you could run the math there. That might actually be true. But I think you need a seal of approval of some case. So for me, going back to investment banking world, recruiting from a target program at a non-target. Went to a public school. I went to Indiana. I had my job in banking before just about anyone, but because the way the program I was in Indiana, the workshop, right, they made you recruit in a way that we had to get started months before, right? You're getting jobs as a sophomore. For some of you graduate, you have to start early. You have to network in a different way. You don't have special application links like some of the schools do. So you just have to work harder. For me, leaving banking and trying to raise a round, I had advantages for sure. Right? I didn't come from a completely slum-like background, and that's a huge advantage. So you can take more risks. But I knew I needed an accelerator. I knew that I had to get into a Techstars or YC or Launch or one of these programs. It's funny now that we've helped so many clients get into these programs and work with clients that are from these programs. We had to get some sort of logo to leverage because we knew the game and we didn't make those rules. For a lot of founders these days, we are that logo. We're not investors like YC. We're not investors like Techstars. But we can be that catalyst, that seed, so that you have our brand to leverage, our network to leverage. Then you don't have to create those relationships, but you're certainly going to have to nurture them, once they're forged. So you need a logo. And if you don't, and if you're not in an accelerator and you've gotten denied from YC 17 times, like I've heard from 100 people getting denied time after time from all the programs, like, you can't just do it on your own. I don't think that that's going to work. I think you can bootstrap, and if you have the metrics, then you can raise, and then you don't have to be in that situation. But you're going to pay for the knowledge and relationships one way or another. You're either not going to raise, and you just jeopardize your entire future, your dream, and you're probably going to be unsuccessful and die, because that's why most companies die. They run out of money. You work with someone like us, and of course there's going to be upfront costs, different sort of compensation, because we're not going to work for free, and no one in our position would ever work for free. So if they're going to work for free, they have no idea what they're doing, and they've probably made no money before. Or you get into a program that, yes, they give you money, but they took 7% of my company with information that I don't have to teach you in 16 weeks. We can do it in 4, and we can accelerate your process in a very different way. So no matter what, you're paying through it. Stock, cash, opportunity cost. You just have to choose what makes sense for you, and you got to get real with that. There will be an investment required, whether you like it or not. Sorry, not sorry. And if you're one of those people that are looking at this, those are the exact people. Bye-bye. Don't come to the show. Like, you're the exact person that we would never want to work with, because you don't have the right mentality. You don't understand ROI. You don't get risk. And you can't do 0 to 1 if you're not willing to take insurmountable risk.
Are you saying that someone that doesn't understand risk shouldn't be speaking to investors about the risk of putting millions of dollars into their business? Is that
right? Well,
kind of contradictory right there?
That's the irony, right? It's like, we've talked to enough thousands and thousands of founders, yet we've worked with like a couple dozen, right? Very small batch. And you'll come and ask, I want $50 million. Some of these people are crazy that talk to us. $50 million. And I have my idea on a napkin. And the thought of ever having to invest in themselves in this process is unimaginable. And it's a very easy thing to sort of push back on. Like, you're going to go and ask investors for millions of dollars with no guarantee of a return. Farthest thing from it. But you have a problem with taking the same deal and putting money into something with no guarantee of a return. You got to work out. Are you a risk taker? Are you an entrepreneur? Are you not? And that's okay if you're not. But jobs are good for a lot of people. There's nothing wrong with working a job. But anyways, that's sort of my thing. I think what you should not do is you should not be willing to just sort of be complacent in whatever situation you're in. Either commit to raising money and don't stop until you get it done, and be willing to cut your losses if it's really not working, or commit going the other way to bootstrapping. Bootstrapping is awesome. We haven't raised capital for our advisory businesses, so we're bootstrapping right now, and it's been fantastic. So we've done both. They're both viable. You just have to choose which journey you're on, and it's not for everyone.
Max,
that's
can
my
I add
tirade.
one last?
Yeah, go ahead, please.
Can I add one last thing? If you're an early stage founder, don't pick a valuation and not move from it.
Yes.
Don't be so stuck on a valuation. I've seen companies go in with strong businesses that refuse to budge on valuation, and they go under because investors understand the market better than they do in these situations.
I'm so happy you mentioned that, Mike, because we're running long and we got to get off. But next week, Friday at 12 p.m. Eastern, which is when we are going to be releasing this show. So if you got excited by our conversation, you definitely should tune in then. We're going to be talking about that very subject, right? Probably the second most common question, if not the first, and we get from clients and folks that are thinking about becoming clients is, how big should my round be, right? What are the real numbers on round sizes? How much do I raise? Valuations. How much should I be diluting? Should I be diluting anything? Because are these people going to help me? These are all very legitimate concerns. And also understanding when an investor is constantly telling you a multiple, you're too early, what that actually means. Like, are you not in a position to raise, or do you just need some help, some strategy, and the better positioning? So we're going to be speaking all about that on the next call, and I think that'll be a really exciting one. I have some hot takes baked up for that, and I imagine you all do as well.
100%.
Once again, and we would love for you to be a client of ours. We have a bunch of free resources in the description, so we're going to be linking social medias. We're primarily there on Instagram short form. We do some Facebook work. Obviously, we have this show going on YouTube, so we'll be dropping social handles and bios in the description. Again, you'll also see a link to apply to GoldCapital Consulting and working with us. This isn't a course. This isn't info crap. This is literally our time. The four of us here working with you from day one, day zero, really, to the end of your raise. And that's the guarantee we do offer. We work with you until the round's done. And you get to work with two amazing companies here, both FTFC and GoldCapital. So if you're interested in working with us as a collective, feel free to click the link, goldcapitalconsulting.com, and click the apply button. And if it's a good fit, we will be in touch to book a call with you. So that's what I have. Anything else before we sign off, gentlemen?
No, good to see you guys.
Yeah, good to see you. Looking forward to the next one, guys.
Go out there and crush it.
Awesome, gents. We'll talk soon.
All right.
Thanks, team.